Every stock we cover on this channel goes through the same process, a full automated analysis that scores the business across several factors and finalizes to a composite verdict. The goal is simple: cut through the noise and figure out if a stock is worth your money, worth watching, or worth avoiding altogether. No hype, no guessing, just the data, the levels, and a clear take. Let's get into it. Here we have ticker XIFR, a clean energy infrastructure stock sitting near $10 with a bull case that could take it to over $21. So why aren't we buying it? Let's break it down. XIFR, also known as XPLR Infrastructure, gets a watch rating from our system today. Here's the two-sentence thesis. The stock is sitting near a long-term flat base around $10, and short-term momentum signals are actually constructive, but the underlying business is burning cash and carrying a dangerous debt load that makes this too risky to own long-term right now. Until the fundamentals catch up to the price action, this is a trader's stock, not an investor's stock. So why is it even on our radar? The price structure score comes in mid-range, but it's telling us something. Price this $10 area. Accumulation indicators are showing positive momentum with a rising velocity. That's the setup. Smart money is sitting neutral to mixed, not running away, but not loading up either. The mid-range technical score is the only bright spot in this entire scorecard. Everything else shows a weak fundamental foundation underneath what looks like a decent short-term technical picture. Here's what you need to understand about XIFR before you touch it. This company is burning cash. Latest operating cash flow, negative $123 million. Free cash flow, negative $397 million. And the projections show that getting worse, not better. Meanwhile, they're carrying $6.2 billion in debt against a market cap of just over $1 billion. Interest coverage is negative, meaning the business isn't even generating enough to cover its interest payments. And revenue is shrinking, down roughly 15 to 20% year over year. Here's the part that catches a lot of traders off guard. The latest quarter actually showed positive net income of $29 million. Sounds good, right? But operating income was negative $49 million, and operating cash flow was negative $123 million. That gap between reported earnings and actual cash is a major red flag. The profits aren't real cash you can use. Our system puts the current price at around $10.71. The base case target is $8.60. That's actually downside of about 16% from here. The bull case goes to $21.48, but that requires a full fundamental turnaround. The bear case, our model shows equity potentially impaired towards zero, reflected as a negative $4.28 implied price. Key levels to watch. There's resistance clustered near $11. That's only about 2.7% upside from current price. Support drops all the way down to $7.60. That's nearly 30% downside. That risk reward alone tells you why we're not buyers here. For XIFR to become a real buy, here's what needs to happen. Operating cash flow has to turn consistently positive. Capital spending has to cool down. It's currently running at negative $274 million. Free cash flow needs to go positive so the company can start paying down that massive debt. Revenue declines need to stop, and revenue quality needs to improve. And leverage has to come down from a debt-to-equity ratio of 1.94. Until those boxes get checked, any rally is likely to be a short-term bounce, not a durable move. Bottom line, XIFR is a watch list name with a 48% confidence score. The short-term setup is tradable if you're disciplined with your risk around that $10 level and targeting 11. But for anything longer term, the fundamentals just don't support it yet. Our composite score comes in negative, essentially flat, leaning slightly bearish. This one's on the radar, not in the portfolio. Drop it on your watch list, set your alerts at 11 on the upside and 990 on the downside, and let the price action tell you the next move. Like and subscribe if you want more breakdowns like this. We analyze stocks which cross our radar using our proprietary model. See you in the next one.